Today is the quarter end review. This might be a little bit longer, so by way of reference, we'll try to keep this to somewhere between 30 and 40 minutes because there is quite a bit of material to cover, but we'll see how long it actually goes. And here's our agenda for today. Unfortunately, Hank won't be able to join us as a special guest because he has he's under the weather just like I was last week. I think there's something going around. But he won't be able to join us today. We will cover some broad economic concepts, the 2022 outlook, and then just revisiting the risks to the outlook, which we presented back in January of this year, and see how that might have changed. So let's take a look at the economic update. And the reason we do this, of course, is because a solid underpinning from economic data has a way of informing where asset prices can and will go. And I guess the good news is that despite the fact that we've got a hot conflict in Eastern Europe, the U.S. economy continues to chug right along at a low but still stable rate of growth. And you can see that here. This is the Atlanta Fed. They put together what they call a real-time nowcast for real GDP. This is for Q1. GDP is just an acronym for gross domestic product. It's a measure of economic activity in an economy. And you can see here, despite briefly dipping below zero, right around the time the Russia-Ukraine war kicked off, we're now trending back a bit higher, which I think speaks to some of the economic resilience that's underneath the U.S. economy, which is positive. Oops. And then looking at maybe other ways we can tease out what's really happening under the surface, because some of these measures will be reported with a lag. And there's some more off-the-run measures that we'll look at. Among others, there's something like this, which is the rail car loads 6-week average. And you can see 2020, the year of COVID, 21, and where we shape up in 22. And I think what we would be looking for here would be a noticeable drop-off in rail car loads, which basically, if rail cars are being loaded, that means economic activity is occurring intrastate, either from ports or into the interior. And what you can see is a pretty positive picture of economic activity continuing to occur, despite the fact that we've got supply chains that are a bit off kilter in a hot war in Eastern Europe. The housing market is another area of strength for the U.S. economy that I think shouldn't go unnoticed. And yes, there are some measures of that strength starting to be chipped away at. But I think it is important to note that despite the fact that we've had a pretty sizable move upward in mortgage rates, that home price appreciation actually ticked up in February, and now we're seeing looks like a little bit of a reacceleration in prices, and that has everything to do, in our opinion, with not only the combination of continued very low inventory levels across the U.S., but also this new category of buyers that has emerged since the financial crisis, and those are private equity firms, otherwise known as financial buyers, are continuing to take off the market somewhere between 20 and 25% of all homes that are being put up for sale. So between these two factors, I think the case can be made that U.S. housing will be resilient despite the fact we have rising interest rates, at least for the foreseeable future. The bugaboo, of course, continues to be inflation and what that's going to be. We did get the report this morning, which I added to this chart here on the far right, which showed that the U.S. economy had an inflation rate year over year of 8.4%, which of course is the highest number since the early 80s, when we had inflation levels of somewhere between in double digits, 10 to 15%. But I think this is really important to keep an eye on and keep track of, because by all accounts, according to most economists that have been surveyed, and even some data that we've been looking at, that it does appear that either this month's March or April CPI number will likely be the peak in inflation from just a rate of change standpoint. Not to say that it can't stay at elevated levels, but certainly I know there's a lot of anxiety about how much higher can inflation go. And just based on some forward-looking indicators of inflation, it doesn't appear it would be a whole lot higher. This, of course, this number is well in advance of the 2 to 3% range that the Fed is targeting. And I think this is one of those variables that if the Fed doesn't get it right, there's a lot that could go wrong, particularly in the bond market. So we are definitely going to be watching as monetary policy shifts, adjust, and occur within the Federal Reserve announcements. But for right now, this number is something that definitely is concerning. And this is where some of the portfolio changes have occurred because of our thought about where inflation is likely to stay over the intermediate term. But again, as I said, there are some measures of inflation that are starting to taper off and even turn lower. And what you see here is one major source of inflation more recently has been the new and used car market. And just shows you that really starting in January of last year, used cars, because of a dearth of computer chips, but also key end components, really took off because of a supply issue. And that's actually starting to turn back lower, as you can see here in the most recent 2 readings from the Manheim Automotive Index. Supply and demand is starting to weigh on future price appreciation that's substantially higher than it is now. So that's positive. One thing that's not very positive, at least relating to inflation, has to do with agricultural prices. This is a chart of the Invesco agricultural fund. It's a composition of a number of different commodity futures, from wheat to grains, corn, livestock. And what you can see here is about a 14-year chart that starting in early part and middle of COVID, call it March, April, that the downward trend in agricultural prices really inflected the other direction. And really, this is about the time that supply chains became an issue. But I think this also speaks to the idea that there is some vulnerability within the food supply chain globally, and that prices are rising in advance of future issues potentially, particularly with things like grain and wheats that are coming out of the Ukraine and Russian economies. But unfortunately, I think this index of agricultural index commodities could go quite a bit higher before we reach a tipping point, because of just the lag effect that it takes from the time that seeds get put in the ground till the time they're harvested. Can be many, many months, as opposed to a few weeks in the case of things like automotive components and the like. The energy markets, however, and this is the Deutsche Bank, the Invesco Deutsche Bank Energy Index, a combination of natural gas, oil, heating oil, diesel, into one composite index. I would say the picture here is a bit less, I guess, dangerous, if you will, as far as price appreciation. Now, there's still some outlier events that could push energy prices a lot higher, like they did back in the 2008 timeframe, when, if you recall, China was rapidly industrializing in advance of their Olympic bid, creating just a sucking of all commodities into the Asia region. But that's not really occurring this time around. And what's driving prices within the energy commodity markets is a combination of a lot of different things, as it always is, because energy markets tend to be pretty politicized, or as a tool for foreign policy in some cases, Russia, of course, being an example there. But we think that the upside, or the outlook for energy prices, isn't as rosy as it would be for agricultural commodities, just because we've had a significant price rise already, and all it will take will be small de-escalations within the Russia conflict to potentially bring those prices back down to at least a more normalized level. But I think some of the damage is already being done, particularly in areas like Europe. We will talk about how we've adjusted our international stock position here in just a moment. But I think what this chart shows you here, well, just for reference, is going back to 2015. This is a plot of wholesale electricity prices across various economies: UK, Spain, Germany, France, and then the US. And what you notice here, of course, is, again, starting in about 2021, a bit of a demarcation between Euroland and US energy prices. Now, we do have the benefit of having a lot of our energy sourced domestically, and that's certainly a huge advantage the US has. But I think what this does is it creates wide economic variables that really would be accruing to U.S. companies as opposed to international or European companies for that matter. Because from a competitiveness standpoint, if your energy prices are 4, 5, 6 times your nearest competitor, then I think that just disadvantages your companies because of that dynamic. And so therefore, we've made the decision more recently to cut our international equity exposure in half, and who knows, maybe even further from there. And then I definitely just wanted to point out here that certainly we don't want to dismiss what's going on within the Ukrainian-Russian conflict. And only reason I wanted to mention this is that there are a number of different variables going on. And unfortunately, they have the ability to impact continental Europe much more so than the US. And so this is just a picture of where various areas are claimed to be held by as of April 9th. And you can see actually the blue regions are areas that have been claimed by the Ukrainian forces as having engaged in counteroffensives. The Russians were not able to overtake Kiev and have pulled back into these red regions, the Donbass regions. But unfortunately, what I was mentioning earlier about agricultural prices is that all through this region are wide wheat and grain fields that are typically being planted during this time of year. And combine that with the fact that we've got very high fertilizer prices may mean that global wheat and grain production might be quite a bit lower than it has been in prior years. And that might spell, food shortages in certain parts of the world, which is the unfortunate byproduct of all that. But again, just wanted to point out that there will be impacts primarily, in our opinion, in Western Europe, and that therefore we should probably minimize our exposure to that region. So let's take a look at what happened during Q1. And Q1, as I'm sure everyone is aware, was not a very positive quarter for many financial assets. There were some that did perform pretty well, but unfortunately that was not the case for the majority of any equity index or fixed income index. And you can see in Q1, S&P, this is US large cap, was down 4.7%. Emerging market stocks, which we exited entirely earlier in the quarter, were down 6.3%. International large cap, that's the EFA index, was down 7%. That's Europe, Asia, and the Far East, Australia. And then US small cap was down 7.7%. So, again, really it was a pretty tight range of outcomes during this quarter. US large cap continued to actually benefit, I guess, from having some geographical advantages, but also some of the largest companies in the world, so that might account for why they held up better. But by and large, it was a pretty negative quarter for equities. And we'll go into the outlook here in a second. For fixed income, it was I would say it's even a bit of a worse picture, because you had, not only did you have, junk bonds and high yield or high quality bonds down, 4.5%, 5%. But for those areas that we don't really have much exposure to, that'd be investment grade or even EM bonds, you're down even more, 7.5%. And then going on 8.5% for emerging market bonds. We've always thought, EM bonds certainly had needed to have a much higher yield to get us very interested. But really what's been going on here is that as interest rates have been rising in the US and the Treasury market, that's putting downward pressure on prices for almost all types of bonds. And that's why a lot of these dynamics have worked out during Q1 that they had from a performance standpoint. And then this other asset category is one I like to just touch on. The best performing category for, I think, the second year in a row now is commodities. Commodities, this is a broad commodity index. The Bloomberg Commodities Index was up 25%. The dollar, interestingly, index versus almost every other currency was up 2.4%. Bitcoin ended with a flat performance for the quarter, which I think is really interesting, given most risk markets sold off during the quarter. So maybe that linkage between technology or high-tech companies and Bitcoin could be starting to wane a little bit, which would be good for people that own Bitcoin. And then the US real estate market, REITs market, was down 2.2%. So how do these dynamics play into our outlook? The picture actually doesn't look too different, although I would just point out this orange square here reflects where we came into 2021 or 2022 with the view, and kind of where we are now. And so you can see by and large where I think our positioning is, and where we still continue to have most of our weightings haven't really changed a whole lot. They have changed a little bit potentially within portfolios, but in broad strokes, this is really how we have stacked out with where we find attractive opportunities. Equity markets still continue to, I think, have some attraction, even though they had a negative quarter. The valuations, but also earnings growth potential, still continue to be attractive to look at. International stocks, however, can present a much less appealing picture, particularly emerging markets, and that I think exit those positions I think has served us pretty well. But also downgrading developed markets is something that we did again for I think various reasons that I discussed relating to the hot conflict on Europe's border. The bond market, by and large, we've maintained a little bit of an underweight position within bonds for quite some time. Recall, for clients that have been around for a while, we started sourcing capital and allocating to alternative strategies maybe about 6 or 7 years ago, to the point where we are now, and I'll go over some of those adjustments in just a minute, but we made another incremental shift out of bonds early in the quarter, mid-quarter, and into alternative strategies. And then alternative markets, these are a sampling of what we would call alternative strategies, private alternatives, liquid alternatives, or even things like real assets, commodities, or real estate. Those continue to attract a lot of interest in our because of what they can bring to a diversifying situation for a portfolio. And here's just some portfolio notes. And here's a summary in this general section of what changes were made more recently. So at the end or last couple of weeks of Q1, the investment committee convened, and here there were a few takeaways from that meeting. One is that we did an across-the-board reduction across every risk profile in our bond exposure, adding to either alternative strategies or cash and cash equivalents. We think that certainly has been helpful, and more recently, particularly in Q2, as bonds have continued to sell off. But that was one of the outcomes of that meeting. Second one was a further reduction in our international stock exposure. This comes after we eliminated entirely our emerging market position in Q1, early in Q1. So on average, what was once a 30% equity weighting to international stocks is now a 15% equity weighting. And then as far as our alternative sleeve itself, we did a little bit of a reconfiguration within the alternative sleeve, consolidating. We had coming into Q1 or 2022, we had a growth version and an income version of our liquid alternative strategies, and now we're actually consolidating both of those into a core strategy that has some parts of each, and each one of them kind of a best ideas, but still more income oriented, that I think is pretty well placed in this current environment given what we've got in front of us. So those are the broad strokes of what was most recently decided on at our investment committee. And looking at how did our portfolios do in each of these categories, I tried to assign a little bit of a ranking or a grading scale. So Q1, our equity strategies underperformed many of the benchmarks, and some more so than others. But I think what we didn't account for was the continued rapid sell-off in some of the growth-oriented strategies, even though we had reduced some of the growth-oriented strategies pretty dramatically in advance of coming into 2022. It just wasn't enough to offset some of the drawdown that occurred in some of those, just a handful of those active growth strategies. And so that really was where the locus of our difference in return in Q1 was on the equity side. Longer term, of course, those strategies will likely be just fine, but nonetheless, it doesn't feel good when that's underperforming. So we just wanted to make sure we made a note of that. And then I think other things that we'll be looking to do potentially here in the near future as we shift out of and make further shifts from international would be looking at maybe a large cap, more value-oriented bias for new positions. maybe slightly tilting the portfolio into a value orientation to really kind of deal with some of the future upside potential and interest rates that will likely drive inflation for the foreseeable future. On the fixed income side, I assigned a positive rating because the strategies did a bit better than the benchmark that we're measuring against. But that's not to say we had positive performance in the quarter, because with such a headwind of interest rates during the quarter, it was very difficult to generate any sort of positive return, because most bonds in general drew down in that 4 to 7, 8% range. That's a bit unusual of a drawdown as well, I would mention. I think this is from a start of the year standpoint, BlackRock puts out a little chart describing this, and I think this is the maybe third or fourth worst start to the year for bonds in general that I think just is noteworthy. That's not to say that bonds can't rally back. Certainly, there will be lots of movements, particularly around interest rates, that are likely to occur later in the year. But that's just something that we wanted to make sure we pointed out, because even though our portfolios did better in the fixed income category, they were still negative, and we certainly don't like to celebrate negative returns. No doubt about it. And I think a focus for ours, just from the fixed income side, will be looking at just additional ways to better manage some of the potential inflation in the bond portfolio that's in front of us, and things like floating rate securities or even Treasury inflation protected securities may find their way in sometime in the near future. And looking at the liquid alternatives, consolidating those two, growth and value, into a single core alternative strategies, I think was a good transaction, or a good migration to make. And particularly when you consider the longer term track record of the alternative sleeve, I think that's just going to make for a better return experience, given that it's a bit more diversified than being either just growth or income oriented. So it's kind of a mixed picture depending on what strategy you were in. But now that we've got one going forward, that'll be a lot easier to message on how those stylistic differences turned out in Q1. So let's take a look at what's in front of us. I do think there's something to consider here when we've got, and I've showed this chart before, and this is the old Russell 1000 growth, Russell 1000 value ratio. And as the chart suggests there, if that line is going up, it means the Russell 1000 growth is outperforming. If the line is going down, it means the Russell 1000 value is outperforming. And I think what you're noticing here, and I think what I've been saying for a little bit of time, is that once this trend line breaks to the downside, it means that value positions would likely be in a better place to start performing better over a longer period of time. And I think we're about, as I was mentioning in my earlier comments, I think we're about at that point where we need to start shifting a little bit more capital into value-oriented strategies in the future, just because we've got quite a bit of cross currents in front of us, and being mindful of some of these trend shifts is really important to keep an eye on. This is another ratio we like to look at. This is the difference between large companies and small companies. So the S&P 500 divided by the Russell 2000, that's a small cap index. If the line is going up, that means the large cap index is outperforming. And if the line is going down, it means the small cap index is outperforming. And so what you notice is after a massive re-rating during the COVID time period, starting here in April of 2020, small caps had a very short window, but very powerful window of outperformance. And then starting at about the year mark after that, went exactly the other way. And we haven't owned any small cap positions for quite some time. I'm really glad we didn't add to any during this time, because we would have been whipsawed into going back the other direction, if we had a small cap exposure. But it's this is actually something that we want to keep an eye on very closely, because small caps tend to lead market rallies over longer periods of time, and the fact they're not right now indicates that there's a lot of churn going on under the surface of the equity markets that we have to be mindful of, potentially setting the stage for recession sometime in the next 6 to 24 months, given what's happened in a number of different other markets. But the good news is, because small cap has underperformed for quite some time, there's not a lot of people that are very bullish on small cap right now, which means that if nobody's bullish, then that actually provides for some upside potential, given it won't take very much incremental buyers to move the market up. And so this is what you kind of see right here, the number of stocks, and this is the Russell 2000, which is the small cap index. And the blue line on the bottom just shows on this index how many small companies are trading above their 200-day moving average. And what you can see right now is that at the most recent reading, only about 30% of the Russell 2000 is trading above its 200-day moving average, which just suggests that there's been a bit of a washout in the small cap index, in that there could be some potential upside in that market, but nothing that will necessarily be very active in, more just a confirming indicator that there could be some upside available left in equity markets in the large cap side. So that's a positive. And then speaking to this investor sentiment issue, this is the Bank of America bull bear indicator. And when everyone is extremely bullish, as the chart suggests, that tends to be a sell signal. Like in February of 21, that's about when some of the large cap growth indexes started to diverge. And when everybody is extremely bearish, that tends to be a pretty good buy signal. And this has got a pretty long established history as well, goes back about 20 or 25 years. And I think what this chart suggests is that with a lot of people bearish right now, or negative on the markets, there could be some upside again left in the tank here, because there's a pretty negative sentiment over the markets right now. And I think the old saying is, markets don't crash when everyone's bearish, that they crash when everyone's really bullish. And that's, I think, just a good indicator right now to take a look at from a sentiment standpoint. But there have been some things that have crashed, and for those that have been tuning into Market Matters, I'm a big fan of finding where the crashes have been, because it just means that sows the seeds for future upside, or lets the market kind of deal with valuation issues different ways. And one market that has crashed pretty spectacularly has been the Chinese Internet Index. And these are, this Internet Index is rebased, starting as if it were to have started in 2019. Versus the NASDAQ during the 99-2004 timeframe. And what you can see is the Chinese Internet Index is down something like 80% off its high, which is just a spectacular drawdown. Companies like Alibaba or JD or Tencent have all seen their shares been cut by 2/3, if not more, because of how China has been cracking down on various internet companies. But this is a very substantial sell-off and derating. And I think that's really positive setup and dynamic, because it means that the speculation in the markets have really come out in a lot of different areas. And if that is the case, then what's left to crash, I guess, is the point. So the fact we've had a variety of crashes in other markets as well too suggests that there could be scope for upside in equities still in the US. And then, getting to the fixed income markets, there's certainly been the area of probably most pain for most clients, or most client portfolios more recently. And I think coming into 21, I think we were suggesting that even though when the 10-year is at 1.7, that a range of somewhere between 2.5 and 275 was likely where rates would end 2022, just given the substantial buildup of inflation that was in the system coming through. Well, we basically almost got there in about 90 days. This is the most recent reading as of April 8th at 272. I think today we're at 270 on the 10-year. And based on some of the inflation coming through, it is possible to have a 3% number on the 10-year sometime in the not too distant future. I would say, though, that based on some of the economic data we're looking at and the trailing off of inflation that's likely to occur sometime later this year, that the odds of actually getting past like a 4% number on the 10-year in 22, in our opinion, is pretty unlikely. And if that's the case, then we actually have the combination of a much better starting yield on our fixed income index right now, Yes, there is some price performance degradation that occurred in Q1, but one of the indirect benefits of rates going up is that your starting yield now becomes a much higher starting yield than when it was before the rates started to rise. So this is why actually in the middle of the 1970s and into the early 80s, bond portfolios actually didn't lose very much value on a total return standpoint, because as the rates were rising, your starting yield every time you rolled that bond over was starting at a higher point. So therefore, your income received was actually offsetting a lot of the price degradation that occurred. Now, very sharp rises in bond yields like what we had in Q1, obviously your yield's not going to compensate you for the loss that you have in your bond portfolio right now. But I think once you get some moderation in yield migrations, or just a slower move in yields, that's how you start to recoup back some of the capital that's been lost from that very sharp price move in Q1. So I think there's some clouds parting on the horizon, I guess is what I would say on the bond side. And I think furthermore, just one thing to think about, going back to the why do we even own bonds at all question that I've heard from a number of clients. It's a fair question, no doubt about it. One of the primary reasons we want to own bonds, particularly right now, is that one of the few things that can perform exceptionally well during very challenging periods like a recession for markets is the bond portfolio. And so you may recall in 2020, bonds had a pretty sizable return in a very short amount of time, because bond yields went from, I think it was the 2-year bond went from 3% at the beginning of 2020 down to 30 basis points at the beginning in March of 2020 or April 2020. And that move created a pretty substantial amount of capital appreciation, but also it was there as the capital buffer. So I think that's one of the key reasons to hold bonds right now, is that with a recession potentially, a number of months out though, although it's probably on the horizon at some point, that's really what's going to perform well as rates come back down, because that's a very high degree way of bringing rates down, is actually to have a recession. And I think that's not lost on the Fed and some of the Federal Reserve governors right now as a way to rein in this inflation issue they've got. And I just wanted to finally note, we did touch on this earlier, but commodities or commodity related companies or just commodity related investments, I think have a decent chance of continuing to perform to the upside, barring any recession, of course. And that's really because we've had a number of decades now of very poor performance in commodities, but also we're now just starting to poke above a 0% 10-year annualized return. And you can see what happens, when you're coming from a low point to a high point. These things tend to generate positive returns for extended periods of time, just based on underinvestment and the cyclical nature of capital investment within the commodities complex. And so just a final piece here is just wanted to revisit some of the risks to the outlook, because it's always important to look at what risks are out there and which ones we identified. And unfortunately, back in this is a slide from January. Unfortunately, we did a pretty good job at identifying what those risks would be, and 2 out of the 3 have already occurred. One is the first one being that inflation would stay, accelerate to the upside and stay above 5% for an extended period of time. This has occurred, and I think certainly we're looking for this inflation number to start to taper off and even turn lower. Because if we stayed up here at these 8% level, 8% is entirely unsustainable for very long in the U.S. economy in particular, given the leverage in the system. And so that's something that we really need to keep an eye out for, is a turn lower potentially in inflation and commodities. And if that doesn't happen, then we need to have a bit of a different look in our investment portfolio. The second one here, the Federal Reserve making a monetary policy mistake. They haven't explicitly made any mistakes yet, but I think a lot of people would argue that the Fed waiting as long as they have to actually start tightening financial conditions is a mistake. We'll see. I mean, this is one of those things that really only comes out in the wash in the bond market will reflect that kind of anxiety here longer term. But we're still it's kind of a wait and see approach, because there are ways to still try to manage this a little bit better with either the balance sheet runoff or raising more aggressively. But we'll just have to wait and see, and this is still probably too early to tell. And then finally, the unfortunate one that we got right was global, what I was calling geopolitical opportunism on the part of Russia or other Eastern European countries, or China, that results in an accidental kinetic engagement. And that, unfortunately, this is what happened. We were not expecting, of course, the degree of commodity price sensitivity to this type of action, but this is also layering into some of the recommendations that we're having to the investment committee about potential commodity exposure or resource-based exposure that could be with us for quite some time if the conflict doesn't simmer down to a more to a ceasefire. I mean, honestly, if anything less than a ceasefire, I think would be not really well received by the markets. And then just want to summarize it in a couple of key takeaways, as I like to do here. We certainly continue to favor stocks over bonds for now. And this was informed, at least in January, by our forward-looking capital market returns forecast publication. And we continue to recommend, on average, slightly higher exposure to equities versus a target range, given the outlook for those various asset categories. We continue to favor things like alternative strategies, whether they be private or liquid, over bond portfolios at the moment, given some of the volatility that's in the bond markets right now, and kind of the uncertainty relating to where bond yields will ultimately land. And I think this is just something that we'll be living with for a little bit of time. And unfortunately, volatility in the bond market and the stock market is going to be with us for a little bit of time. And as I was saying, coming into 22, it's just going to be a year of blocking and tackling, because you can see Q1 was a pretty violent quarter from not only price movements within bonds but also in stocks. And I think having a way to capitalize or capture some of that volatility, either through rebalancing or through some targeted shifts within the asset allocation, or even strategies that are maybe option-based that can benefit from high levels of volatility, are ways that we're going to manage through this year, hopefully to a positive return by the end. So we'll have to just see how that evolves. So that's all I had for today. We're kind of bumping up against our time limit of between 30 and 40 minutes. Hopefully I covered all the info that you all were looking to hear today. If not, please feel free to reach out to your wealth advisor, and we'll get back to you as soon as we can. Thanks for your time. Have a nice day.